Welcome to The Explainer. Today, we're jumping right into a really fascinating analysis. We're setting out to decode the massive upside projected for India's absolute largest private sector bank, HDFC Bank. Now, if you've been following the financial sector even a little bit, you know this institution has been navigating a pretty complex landscape post-merger. But according to some top-tier institutional research, the foundation has essentially been set for a major breakout. Okay, let's dive right into this. The headline target price being projected here is a massive 1,100 rupees per share. When you actually calculate that out, we are talking about a projected 35% upside from recent levels. I mean, that is a bold statement for a bank of this sheer size. It immediately begs the question, right? What exactly is driving this level of optimism? How does a behemoth like HDFC Bank realistically plan to grow by more than a third in value? Well, to answer that, this entire explainer is built directly on a comprehensive and frankly incredibly detailed institutional research report from Motilal Oswal Financial Services. We're going to unpack their data, look under the hood at the bank's internal metrics, and see exactly how they arrived at this highly bullish thesis. We aren't just guessing here, we're following the math. To understand the actual destination of that 35% upside, we've broken this down into four core building blocks. First, smart loan growth. Second, the deposit advantage. Third, the digital and AI leap. And finally, the final valuation.
Section 1. Smart loan growth. Let's see how they're revving the asset engine. Before we even look at the specific loan types, we've got to understand the macro picture of the bank's liquidity, which is represented by the credit deposit or CD ratio. Basically, this is just the proportion of a bank's deposits that they're actually lending out. A lower ratio usually means better liquidity and honestly, less strain on the system. HDFC Bank has successfully eased its CD ratio down to 94.6% in FY26. That's a really sharp improvement from 96.5%. And they aren't stopping there either. They are strategically aiming to bring this down to 93% by FY28. Basically, they're creating critical breathing room.
Breaking down their actual loan mix, retail is sitting at 49% and corporate is at 27%. But the real star of the show here, the secret weapon, is the small and mid-market segment, currently at 21%. HDFC Bank is intentionally driving its growth through this highly profitable segment, particularly in business banking, which saw a staggering 17% year-over-year growth. They're actually sacrificing a little bit of volume in other areas just to capture high-yield, profitable growth right here. Now, what's really interesting about this is that even with aggressive growth targets, their risk management remains incredibly disciplined. They've safely reduced their unsecured loan mix down to 10.8%, which is notably lower than a lot of their private peers. Personal loan growth, carefully calibrated at just 9% year-over-year. And as a result, they're maintaining industry-leading asset quality. We're talking gross non-performing assets at a tiny 1.15%. And just in case the macro environment takes a turn for the worse, they're sitting on a massive floating and contingent provision buffer of 371 billion rupees. So they're growing fast, absolutely, but they're playing it incredibly safe. Moving on to Section 2, the deposit advantage. This is the high-quality fuel. A super unique advantage for HDFC Bank right now involves FCNRB deposits. These are foreign currency non-resident accounts, and they're used to mobilize overseas funds. So why does this matter to us? Because the RBI has introduced swap windows for these, and HDFC Bank is perfectly positioned to tap into its massive NRI customer base to gather these funds. To give you some context on their scale here, during the 2013 window, HDFC captured a massive 13 to 14% market share of all FCNRB inflows. They are a literal powerhouse in this space, and they're using it to securely and, more importantly, cheaply fund their domestic growth. And you know, it's not just overseas funds. Their domestic deposit engine is absolutely roaring. In FY26, HDFC Bank grew its deposits by 14.4%, officially outpacing the entire banking system's average of 13.5%. What makes this incredible, and what you as an investor really should care about, is that they aren't doing this by crushing their margins in some aggressive interest rate war. Not at all. They're doing it through superior customer engagement, a highly diversified product pool, and just way better technology. So why do all these cheap deposits matter in the grand scheme of things? Well, following the massive merger with HDFC Limited,
The bank's expensive borrowings actually peaked at 18% of their balance sheet in March 2024. But here is the exact timeline for their margin expansion. Between FY26 and FY28, about 20% of that high-cost legacy debt is due for repayment. By March 2028, they're explicitly targeting to reduce overall borrowings down to just 8% of the balance sheet. They are actively swapping out expensive high-cost debt for much cheaper customer deposits. That right there is a direct mathematical driver for long-term margin reflation.
Section 3, Digital and AI Leap. Let's talk about the operational multiplier. Listen, HDFC Bank isn't just giving its app a fresh coat of paint. They are completely embedding AI across their business functions to drive operating leverage. They've established a brand new technology and digital center in Guwahati purely to enhance execution capacity and build a future-ready talent pipeline. They are seriously laying the groundwork for a much leaner, much faster institution. So the crucial point here is their bespoke technology platforms, specifically their unified in-house AI platform known as Neve. Neve isn't just a basic customer support chatbot. It's the fundamental base for deploying AI capabilities across the entire bank. It handles real-time customer engagement, it automates trade operations, and it provides highly intelligent monitoring for risk oversight. It is literally the secret sauce behind the bank's impressive improvements in their cost-to-assets ratio.
And the sheer scale of this digital pivot is absolutely staggering. PayZap 2.0 has already scaled to 208 million registered users. Their merchant platform, SmartHub Vyapar, is currently processing 4.7 trillion rupees for 2.4 million merchants. They're rolling out Gen AI agentic bots to equip frontline employees with real-time info so they can instantly serve customers. And over on the retail side, their Express car loans now see 51% digital origination. Why is this a game changer? Because they're capturing massive loan volume with almost zero incremental operational cost. All of that goes straight to the bottom line.
Finally, Section 4, the final valuation. Time for the sum of the parts math. And this brilliantly illustrates how we actually reach that 1,100 rupee destination. We use a sum of the parts valuation. So the core banking engine itself is valued at 967 rupees per share, which makes up roughly 88% of the total value based on their projected FY28 adjusted book value. But then you have to add in the incredible subsidiaries. HDFC Life Insurance adds 54 rupees, HDFC AMC adds 48, and HDB Financial Services adds 33. After applying a standard 20% holding company discount to those subsidiaries, which brings it down by 33 rupees, we arrive cleanly at that total target price of 1,100 rupees. Which leaves us with a really critical thought for you to ponder today. We've seen exactly how they are strategically shedding expensive debt, gathering deposits faster than the industry average, and heavily scaling AI to process trillions of rupees digitally. So, looking at the pure fundamentals laid out in this research, does HDFC Bank's digital pivot and deposit strength make it a cornerstone for your portfolio? It is definitely a compelling case for a 35% upside. Thank you so much for joining this explainer. I highly encourage you to take these insights, dig even deeper into the banking sector, and just keep learning. Until next time.